Hello, welcome to the Investment, Fiduciary and Pension Division Update. I'm Gillian Browning and I'll be talking you through a number of slides covering the health of these important sectors, our recent Guernsey Green Fund thematic review. I'll be sharing with you hot topics that are raising our supervisory eyebrows and providing an overview of our current policy work and sharing some insights into our aspirations for the year ahead. Roughly a year ago, we started collecting monthly data from our most significant licensees to understand the impact COVID-19 was having on their business. This data has been submitted from our most significant licensees on a best efforts basis. In terms of representation, they employ over 50% of the workforce in these sectors. They represent over 70% of investment turnover and over 60% of assets under management within the investment sector. We'd previously collected annual turnover data, as illustrated by the dotted lines on the chart. Now, this graph illustrates that investment licensee turnover for 2020 is on track to be at least on par, if not ahead from previous years, despite all the challenges that COVID-19 has thrown at us. We intend to maintain this return for the next while, albeit moving its frequency from monthly to quarterly. The data collected here helps us to understand more about the composition of our fees for our key licensees, which can be an indicator of business model vulnerability. For example, the dip in April reflects the initial COVID-19 impact on NAV-based income, and the September spike correlates to a crystallisation of performance fees. Moving from licensee income to fund NAV, Guernsey funds are a key part of the bailiwick's financial ecosystem. As a reminder, at the end of 2020, the NAV of Guernsey funds stood at £245.5 billion. That's an increase of 7.8% year on year. Now, this chart breaks down all those Guernsey funds and depicts them by the year they were first authorised or registered. This gives us insights into our future fund population if we work on the basis of accrued replacement rate. The charts in front of us illustrates, via the dots, the healthy number of funds authorised or registered in the past few years. Now, we'd expect there to be a lag between fund authorisation and NAV growth, although possibly we'd have expected to see the NAV of funds launched in 2017 to be slightly higher by now. The chart also illustrates, via the blue bars, our dominance in the closed-ended fund space, particularly over the past decade. Over the past couple of years, we have formed the Investment Data Working Group, which has representatives on it from GIFA, Guernsey Finance and the States of Guernsey. We've seen real benefits from working together, analysing the data the Commission collects for maximum mutual benefit. And I'd like to thank the members of that group for all their time. One observation of possible wider interest that came out of our recent meetings was the potential trend in increased fund term extensions. Closed-ended funds running for longer than they originally anticipated to, due to potentially market conditions or investor demands. The first pie chart on this slide reflects the NAV of Guernsey funds by currency. It's fairly static year on year, but I share it with you as it illustrates how vulnerable the Guernsey fund NAV is to FX movement. Future increases or drops in NAV may not reflect performance or inward investment, but rather may simply reflect currency movements. The second chart, again fairly static year on year, illustrates our continued specialism in the private equity space. In addition to administration of Guernsey Fund, the bailiwick also administers a large number of vehicles that fall outside the definition of a collective investment scheme or a Guernsey fund, but they're still investment structures. We are progressing with gathering more data on the volume and value of these structures. However, looking at the number of general partnership fiduciary discretionary exemptions we grant each year is one proxy to illustrate the size and maturity of this market. As can be seen by the chart, the number of general partnership discretionary exemptions has grown over time and has consistently been over 80 per year for the past 5 years. This chart represents numbers of exemptions, not values. However, some could reflect material investment structures. As an aside, we estimate roughly a quarter of these GP exemptions relate to carry interest and co-investment vehicles, which the forthcoming ancillary vehicle consultation paper proposes becoming an automatic fiduciary exemption and a notifiable investment activity. So what am I saying? Well, the investment sector in Guernsey is resilient and material, not just in the collective investment scheme space, but also in the wider investment structure landscape. And we're currently making policy proposals and changes to support this market further. We've also been collecting monthly COVID-19 impact data from our most significant fiduciary licensees. The data on this chart represents licensees that represent over 60% of all fiduciary turnover and over 70% of the assets under management within the fiduciary sector. Because this is the first year we've collected this particular data, we're still learning about the cyclical nature of fiduciary income. For example, will we see a dip in income every holiday season due to reliance on time spent income? How much of the April dip was due to licensees moving to working from home? I'm going to share further data on fiduciary licensee turnover in a minute, based on our annual returns, but wanted to comment here that the composition of fee income is different to that of investment sector. But that said, we haven't observed any financial stability issues with any of our investment or fiduciary licensees over the past year. As in previous years, the fiduciary annual return provides us with a rich data set upon which we analyse trends. All the data is at 30th of June for a particular year. Overall, the fiduciary industry remains stable, but we have been observing a steady trend of consolidation, amalgamation of licensees, and this is something we expect to continue. There is often a delay between the consolidation and surrender of a fiduciary licence because the businesses need to be tidied up and clients transferred between entities. All our data is based for this year on 142 full fiduciary licensees. That's compared with 148 from 2019. Now this chart illustrates the continued growth in licensees that identify as being part of an international financial group. These are, for example, private equity-owned fiduciaries. The number of the licensees are plotted along the bottom of the chart, and the chart illustrates the value of the assets they are acting as trustee or corporate service provider for. Across all ownership types, there is a trend of continued growth in the sector, with assets under fiduciary regulated activity growing overall 6.8% since 30th of June 2019. These assets are roughly divided between trust and corporate service related activities. Other metric that might be of interest would be that the annual return highlights the fiduciary sector still employs over 10% of the total Guernsey workforce. It was 3,849 people last year. And on average, each full-time equivalent member of staff employed has 13.5 appointments, compared with 13.9 from the previous year, and generates £170,000 worth of income, compared to 162 the previous year. So building on from the previous slide, these two charts illustrate in pictorial form the evolution of the fiduciary sector over time. On the left, we clearly see the decrease in the number of appointments as trustee or director, and an increase in the value of assets being managed by fiduciary licensees. I've commented on this before, but it's a reflection on the jurisdiction moving to fewer, higher value and more complex structures. On the right, over a 16-year period, is the same data on the number of appointments, but compared to licensee turnover. The total annualised fiduciary income for 2019-20 was £354.2 million. That was effectively flat from the same period the previous year. Breaking that turnover figure down further, 31% of total fiduciary turnover originates from the UK, 11% from Guernsey, and 6.6% from South Africa. Very similar figures to the previous year. Now, the same top 10 locations account for 78% of all new fiduciary business. This includes 31.2% coming from the UK, 17.5% from Guernsey, and 8.2% from South Africa. Since the introduction of pension scheme regulation in 2017, we've been monitoring its growth via quarterly returns. It's clearly a much smaller sector than either the fiduciary or investment sectors, but it is growing. Firstly, the red line shows that the total value of assets has increased from 8 billion in October 2017, rising steadily to 11.8 billion at January 2021. The grey line reflects membership numbers growing from 93,000 to 118,000 over the same period. There was a slight fall from 122,000 members in April 2020 to the 118,000 in January this year, which was largely as a result of a couple of schemes being cancelled later in 2020. And each one of those schemes had in excess of 1,000 members. We know from the first set of annual data that the majority of scheme assets are relatively concentrated into investment products, which we include funds, structured products, ETFs, and collective investment schemes. So finally, what type of pension schemes do we administer in the bailiwick? Well, we service two distinct scheme types: personal and occupational. As seen from the first pie, the majority of the schemes by number are personal, but the majority of assets are in the occupational schemes. The second pie illustrates of the current population of 118,000 members, many fall within the larger occupational type schemes. In fact, there are 41 schemes with over 500 members, and 25 of these have over 1,000 members. At the smaller end, as illustrated by the blue sections on the chart, there are fewer members but a larger number of schemes. In fact, 81% of all schemes have just one or two members. These are, for example, our local RATs. Whilst large in terms of number of schemes, these only account for 12% of the total scheme assets. The vast majority of Guernsey regulated pension schemes are defined contribution. The annual pension data also shone a light on fees and charges. Our analysis, perhaps unsurprisingly, identified that personal schemes where members had a smaller pension were more likely to be charged a higher fee as a percentage of their pot. Now, this could be due to fee structures, for example, where there's a flat rate charged and the amount is small in relative terms. But the fact remains that members with fewer funds are more likely to be charged a multiple of fees of members with higher value pensions. Overall, licensees' annual revenue was less than 1% of scheme assets in 78% of schemes. Total scheme expenses were less than 1% of scheme assets in 56% of schemes. However, there were some significant outliers in terms of charges, and we are seeing schemes where fees are materially eroding the value of funds, and that pension may not be in the members' best interests. As a reminder, the Guernsey Green Fund rules were introduced in 2018 with the objective of creating a regime in which investors could be assured that their investments had a positive environmental impact on the planet and monitored against internationally recognised criteria. We believe that this was one of the world's first regulated green investment vehicles and supports something that has gone from being a minority interest to a mainstream concern in only a few years. As at the end of 2020, the Guernsey Green Fund NAV was around 4 billion. All the accredited funds are closed-ended structures, which reflects the long-term nature of those underlying investments. we felt it was important to undertake a thematic review of our existing Guernsey Green Fund population. The thematic review was published in March 2021 and contains far more details that I'm going to be able to relay in the next few minutes. But in essence, it sought to gain a fuller understanding of the green funds, to assess their compliance with rules, and to gain reassurance that our green funds are not in any way contributing to greenwashing. This is something we have zero tolerance for. Our key findings were encouraging. Guernsey Green Funds do invest in projects which comply with criteria for green investments set out by the multilateral development banks. However, there were also lessons to be learnt, especially for designated administrators of Guernsey Green Funds. Some of these administrators have received tailored feedback and accompanying risk mitigation programmes. The thematic review provides far more detail, and I hope you may have a chance to read it. However, I wanted to draw out today 5 key takeaways for designated administrators. Firstly, the Guernsey Green Fund is based on Guernsey licensed administrators carrying out sufficient due diligence at application stage and fulfilling ongoing requirements that the fund is monitored against notified green criteria. In order to do this successfully, the designated administrator must establish reporting and monitoring requirements, or else they are effectively operating blind. Once reporting and monitoring is established, it needs to be documented in order to ensure a good audit trail that evidences how ongoing oversight obligations are fulfilled. Thirdly, the Commission's expectation is that the actual calculation of environmental impact of the investments won't be undertaken by the designated administrators or part of their contracted responsibilities. However, the assessments would be carried out by the manager or a third party, and that these should be provided to and scrutinised by the designated administrators. It was apparent during our review that monitoring of environmental impact did occur at investment management level. However, the quality and quantity of environmental impact reporting received by the administrators varied, as did the scrutiny applied to the information received. On the positive, the Commission remains committed to the Guernsey Green Fund regime and encourages more schemes to consider seeking accreditation, something that the Commission doesn't charge for. Finally, climate risk is becoming one of the key risk areas which we should all be considering. We're encouraging all licensees to consider the impact climate change will have on their business strategies and to discuss sustainability matters in an appropriate way with their clients. The thematic review hopefully helps complement this wider conversation. So moving gear, what is raising our supervisory eyebrows at the moment? Across both the fiduciary investment sectors, there are 3 particularly hot topics. Firstly, the continued trend of mergers and acquisitions. Now, they happen frequently, but frankly, the times it goes well are far outweighed by the times when there's pain after purchase. One of our observations is that there's a lot of effort put into completing the deal, making that purchase, and far less resources are put into integration or remediation. This is repeatedly a costly mistake to be wary of avoiding. Outsourcing is another perennial trend. We see more mixed practice here. Some outsourced arrangements are entered into with thorough monitoring arrangements, assessment of resource needs, and clarity regarding accountability. Some centres of excellence bring genuine corporate and customer benefits. However, this is an area the Commission is closely interested in and would remind all licensees that it's in our collective interest to remain a jurisdiction of substance. I've spent a fair proportion of today sharing some annual data highlights. What never ceases to amaze me is the poor quality of submissions we receive from you. It's not an unreasonable leap to then question if the data to the regulator is incorrect, what else is wrong? Recently, we've issued a reminder about the importance of reporting accurately when there's been an emphasis of matter, to not tick no when in fact there has been an emphasis of matter. The amount of quality control work undertaken by supervisors to clean up data submitted to us is disappointing. Again, we consider that it's in our collective interest that you only need to report the data once, and that it's accurate first time, with no surprise zeros added or numbers double counted. Focusing on the investment sector specifically, we will draw out 3 key topics attracting our frowns at the moment. Firstly, and this is picked up in our annual report this year, we observe a wide variety of quality amongst fund directors. This manifests itself in some fund directors failing to understand the rationale for a particular structure, failing to validate the nature of assets, and failing to take accountability. It seems that if there's a problem, it's always somebody else's responsibility. The second point relates to fund directors, but also other service providers too. For example, administrators, custodians, and possibly even auditors. We observe a failure to manage conflicts of interest, with bailiwick individuals being unduly seduced by the pull of ongoing fees over and above whether it's actually in the long-term best interest to keep the fund running. Thirdly, and this is a topic we're likely to focus on more in the future, is making sure a designated administrator's role in the investment sector is clear. The way the POI law is drafted means that responsibility for a particular issue can end up with the administrator, and we're going to look to work through specific regimes, as we did with the Guernsey Green Fund, to ensure regulatory clarity and to work to remediate issues within the sector when found. So, turning to the fiduciary and pension sectors, our eyebrows have been raised recently in the following 3 areas. Firstly, complaints regarding pension transfers have materially increased over the past few years. Whilst there are important and legitimate reasons to decline transfer requests, including where significant risks to scheme members have been identified, we do not want to be known as the Hotel California of pensions, where members and schemes can come but never leave. Unfortunately, we're working with a number of licensees who appear to be placing unreasonable barriers in the way of scheme members who request a transfer, and could be accused of prioritising their own revenue streams ahead of scheme members' best interests. Secondly is the age-old topic of understanding and managing conflicts of interest. We've been surprised this year by some apparent fundamental misunderstandings about what may or may not constitute a conflict of interest. Finally, we are noticing from on-site visits some entities which still have not sought tax or professional advice, or equally haven't considered what they've received. To be clear, this doesn't mean we expect you to get opinion after opinion on the same issue. However, we do expect to see evidence of common sense scrutiny by directors. We know failure to obtain and maintain up-to-date professional advice has led to legal action and/or disclosures to HMRC and tax authorities, both of which are a resource drain on our licensees. In terms of policy development, we balance a trilemma: creating an enabling environment for good business growth, protecting investors, members, beneficiaries or clients, and preventing financial crime. With that trilemma in mind, we've been making good progress in a number of policy areas, as illustrated on the screen. The top 2 hexagons cover our new live rules, the fiduciary and pension rules, which commenced at the start of this year, following a transition period. These provide what we hope will be the firm foundations of regulation in these areas for many years to come. The next 2 hexagons relate to what I hope are imminent rule changes. I've pre-recorded this session on the 31st of March, and we're hopeful that a number of additional policy changes are just on the horizon, possibly even predating this presentation being viewed. The first are changes to our PIF regime. The proposals made in our 2020 December consultation paper were widely welcomed by respondents and seek to create 2 new PIF registration routes. one based on funds restricted to professional and institutional investors, and the second limited to a group of family investors. Each of these two additional routes would not require a licensed Guernsey manager, but as for all the other fund regimes, will require administration by a locally licensed fund administrator. The second change would be to follow up on our proposal to abolish non-Guernsey scheme rules and instead collect additional data. Further communication on this is likely to follow in the next couple of months. The third row of hexagons is a shameless plug for our current live consultation paper. At only 6 pages long, including a covering page and 2 pages of appendix, it hopefully isn't too off-putting. Responses are sought by the 5th of May 2021 in respect of the proposals to make an addition to the Finance Sector Code of Corporate Governance to take into specific account climate change considerations, plus 2 minor modifications to the Guernsey Green Fund rules. The final row relate to 2 imminent and much-trailed consultation papers. The first considered changes to the fiduciary rules necessitated by the revision of laws project, including the introduction of primary and secondary licensees, but also the proposed deregulation for personal fiduciary licensees who may wish to advertise their services. The second, as touched on earlier in this presentation, covers the new automatic exemption from the fiduciaries law when they've been notified to the Commission under our investment framework and meet restricted characteristics. And finally, a look through the window in the Rock Sark towards the future. We've been conscious for some time about the global tightening in the professional indemnity insurance market. We commenced a thematic review towards the end of last year, and we're currently analysing responses and will share our findings over the summer. COVID-19 has forced us all to adapt, especially when we were in lockdown and working from home. One of our lessons from this period was the benefit of undertaking a more thematic supervisory approach. And thus, in the future, we intend to conduct more themed visits. Eventually, we'll be undertaking fewer detailed on-site inspections, and instead we will select 1 or 2 particular risk areas and analyse multiple licensees in this respect. We have found that outliers soon jump out, and we can then focus more of our attention on these areas. Last but not least, there have been some innovative and encouraging work going on behind the scenes at the Commission in the subtech space. Our hope is to keep in the pack of technological advancements, for example in AI, to free up supervisors to spend more time on real material issues of regulatory concern and less time on processing bits of paper. So in summary, if I was to ask you to take away 2 things from this talk, it would be that the investment and fiduciary sectors remain healthy and resilient in the bailiwick. However, yes, of course, there are areas for regulatory improvement, and it's in our collective interest to understand what these areas are and work together on them. Thank you for listening.